Welcome back to Strongman Personal Finance. Today we have another Ask Me Anything with Strongman. And this video is going to be about how to invest tax efficiently. Now, this is actually a really good question this guy sent me, and I'm more than happy to answer it. And if you have questions about anything investing or politics related, shoot me an email. It's in the description, and then I will give you a live video response for free. You can't beat it, baby. All right, let's read this excellent question that I got from a man named Mr. W. We'll keep you anonymous, Mr. W. And his question is, can you go in depth about asset location for maximum tax benefits? In particular, I'm interested in asset location of securities and index funds between tax advantage accounts, aka tax-free growth, and non-tax advantage accounts. Assuming you want to hold some money in both of these pots, which securities should be in which accounts? Maybe low rank, low growth dividend, growth stock, index funds, bonds, blah, 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 blah. I understand that dividend paying stocks should be mostly in tax advantage accounts because they generate income, and lower growth should be in taxable accounts. Not sure about index funds though, so maybe talk about taxation on those. Also, I mostly consider taxation and taxable accounts as capital gains, as I wouldn't sell in the first year for maximum savings. What I've been doing, since I'm pretty sure I'm 100% stocks for maximum IRR long-term, is putting 0% dividend stocks in my taxable account. That's good. As my emergency savings account, that's not that good, and I'll tell you why. Also curious about buying real estate and 529s with maximum tax efficiency. Real estate and 529s, maybe which states have good plans. All right, so there's a lot of questions in this one, and I want to start off with the first thing you mentioned that I disagree with is having your emergency savings in dividend stocks. Now, your emergency savings should be held in cash and cash only because stocks are too volatile in the short term to really be able to produce or give you the money that you need in a pinch. Let's say you have an emergency and your car breaks down. Well, you need money ASAP to pay for that car. Now, if the stock market gets crushed, even like dividend stocks that normally aren't volatile, if the stock market's really down and you need an emergency or you have an emergency, you have to sell those stocks at a loss, which is not good, in order to pay that emergency bill. It's better just to take the hit, the investing hit, and have 3 to 6 months of cash in a high yield savings account. And that is there and it sits there and it's only there for emergencies. It's better to have that than to have to go and sell your investments at a loss during a market downturn because you have an emergency. So I don't think you should have any of your dividend stocks as an emergency savings account. Now, going back to the first question, how do you maximize tax benefits? Well, if you're not going to retire early, if you don't plan to retire before 59 and a half, you shouldn't have any money in a taxable account. Now, if you have a short-term goal, like let's say you want to save for a house down payment in 5 or 10 years, okay, you can put money in a taxable account. But if you're not maxing your Roth IRA, and I don't know if you have a spouse, your spouse's IRA, and if you're not maxing your 401k, and your spouse's 401k, and you don't plan to retire until after 59 and a half, you don't need to put any money in taxable accounts. The only reason you have taxable accounts is if you want to retire before 59 and a half. That way you can sell the investments and generate income for yourself before you can access your tax advantage accounts. Or if you have short-term goals, like you want to have a house down payment in 5 to 10 years, or you want to go on a dream vacation in 5 to 10 years, that's when you would put money in a taxable account. And you could invest it in stocks because over 5 or 10 years, you're not going to have a problem with, market downturns in the long run. Now, I recommend max your Roth IRA, max your spouse's IRA. That's $12,000. You pay the taxes up front, you put the money in, and it grows tax-free for the rest of your life. And then you can take it out at 59 and a half with no penalty. You should also be maxing your 401k, $19,500 plus whatever match you get and your spouse's 401k. That's what, almost $40,000 just in tax advantage 401k accounts, plus your Roth IRA contributions of $12,000 per year. That's $52,000 per year. And if you don't need it till retirement, you might as well just put it in a tax advantage account. That's the way to do it. You don't have to worry about it. It just sits there. It grows tax-free. And if it's a Roth 401k, you take it out tax-free. If it's a traditional 401k, you're going to have to pay taxes once you withdraw it at ordinary income rates. Now, different securities, let's say you do have money in a taxable account. Different securities have different rates of taxation. Now, the first thing that comes to mind is if you have any kind of bonds. Bond interest is taxable at ordinary income rates, which is not good because ordinary income rates, they can go up to like 37%. And who knows what they're going to be if there's a new tax law that goes into effect. So right off the bat, if you do want to keep some money in a taxable account, you do not want bonds in a taxable account because they will kill you. You might think you're getting a 3 or 4% return, but after you pay those taxes for the federal government and the state, you're not getting the return that you think you're getting. You're actually probably getting a lot less because the government loves to take money from people, okay? And bond interest is one of the ways that they save money because they pay you the interest and then they tax it. Now, another thing, real estate investment trusts. The income that they pay out is mostly taxable at ordinary income rates as well. So if you have any real estate investment trusts and you want to split it between a taxable and tax advantage account, you want the REITs to be in the tax advantage accounts. Now, there are two types of dividends. There's, I believe, qualified dividends and non-qualified dividends that stocks pay out. And if you remember, a dividend is just a company profits and they pay out a dividend to the taxpayer or to the shareholder. Now, dividends are not a good thing in my opinion because they come out of the company's equity. You're not getting free money. So the company's stock value actually decreases whenever they pay a dividend. So all you're doing, if you have it in a taxable account, you're just literally paying taxes for nothing, and you're not getting any real value out of it. Now, if you want to retire and live off dividends, that's something else entirely. But if you're building wealth and you're paying dividends, any kind of dividend taxes, that's not good. And I made that mistake too. I actually have like a target retirement fund in a freaking taxable account, and I pay hundreds of dollars in dividend taxes every year. It pisses me off. I should have put that in a Roth, but I was dumb. So even dividends, you don't want those in taxable accounts. Now, you can have, if you want to have a very tax efficient investment in a taxable account, you want a low dividend that pays qualified dividends, which are treated at ordinary, or not ordinary, but preferential tax rates in your taxable accounts. Now, non-qualified dividends, and there's some stocks that qualify for qualified dividends and certain stocks that qualify for non-qualified dividends. Qualified dividends have good tax rates, lower tax rates. Non-qualified, you're going to pay ordinary income on it. So if you see a fund that has a high dividend yield and most of it is non-qualified, that's not very tax efficient. You don't want that. Now, if it pays qualified dividends and it's just a small amount of the portfolio, great. That's better than, getting real estate investment trust income or non-qualified dividends. So if you're putting money in a taxable account, you want low turnover in your investments, which is what an index fund provides for you. And you want no interest, no dividends, nothing. That's ideally what you want. All you want is to have capital gains appreciation because then you don't pay taxes till you sell. So you could grow that capital gain or that investment for 10, 20, 30 years and not pay a dime in tax because you're not having any kind of dividend or interest or, any kind of money paid out to you. So ideally, just own a total world stock market index fund if you want a taxable account, if you want to invest in a taxable account, because index funds have very low turnover. And how I explain turnover is if you're managing a fund and you're buying or selling stocks in the fund, every time you sell, the portfolio turns over. You're actually trading out stocks. And the more you're selling, the higher your turnover. And what that does is that actually creates capital gains taxes that the mutual fund is going to pass down to you. So if you see a fund with like 100% turnover, 200% turnover, that's very tax inefficient, which is probably an actively managed fund. But if you have an index fund, their turnover rates are so low, which means you're really not paying that many taxes. So if you have any money in a taxable account, it needs to be in an index fund with preferably no dividends, but it's hard to avoid that with an index fund, but as low a dividend payment as possible. Because the more dividends you get, the more freaking taxes you pay, and you get nothing because dividends aren't free money. Now, that's it for index funds. Buy index funds in a taxable account, max out everything else. And if you do that, you'll be good. And at 59.5, you can take out that money in your tax advantage accounts tax-free if it's a Roth. All right, what other questions did you have? All right, I can go a little bit more in depth about index fund taxation. So obviously index funds are designed to track a market index. So they're very tax efficient because you just buy the stocks in the index and that's it. You just let them grow. And if it's market cap weighted, well, the stocks grow or fall and you don't really have to make any adjustments. Now, the good thing, like I said, they're low turnover and they're, that's basically the main thing with index funds, low turnover and low fees. So you have good tax efficiency and you have good expense ratio. So index funds only, low dividends in a taxable account. But if you're not maxing your tax advantage accounts, you don't really need any kind of money in a taxable account unless you have a short-term goal. Now, buying real estate. Now, if you want to invest in real estate, I don't recommend it personally because it's a very concentrated investment. You're putting a lot of money and a lot of time and a lot of effort into one house. Now, if you go buy a real estate investment trust, you're buying a broadly diversified portfolio of all different kinds of real estate, healthcare real estate, telecom real estate, and you own a piece of real estate throughout the country. You own thousands of properties or tens of thousands of properties. If you invest in your own real estate, your own house, well, that's one investment. That's one house in one city, in one state, in one country. That is not diversified. And all the work you're going to have to put into it, it's a pain. Now, with real estate income, you actually have a lot of stuff that you can write off. You have like depreciation, yada, yada, yada. So a lot of the times, especially up front, you're probably going to have a lot of losses on paper if you're renting out real estate because of the tax benefits. And if you actually make a low enough income, you can actually, use those tax benefits going into the future, or you can write it off against your ordinary income. So real estate is not the worst investment. Like if you really want to be a real estate investor, you go ahead and do it. And I'm not going to stop you. I'm not a licensed financial advisor, but I wouldn't recommend it personally because it's just not worth the hassle and it's not diversified at all. Just buy real estate investment trust inside a tax advantage account and boom, you don't have to do anything. You get decent returns, high dividends, and they're not taxed because they're in a tax advantage account. Now, 529s. 529s are pretty good. The only thing you need to be careful of, and if you don't know, a 529 is for it's a college savings account. And you can use that to pay most expenses for college. Now, some states offer good tax deductions. I don't remember which state is good. I think a quick Google search will say best 529 plan, and you can find the state that has the best tax advantages. Just keep in mind that your specific state might offer tax advantages for residents of that state that make it attractive for you just to use your own state's plan. Like I live in Virginia, and I think they give like a $4,000 deduction. So, I did the pros and cons and I said, okay, I'm just going to stick with Virginia because my state gives me tax advantages. So it depends on the state, but once you put the money in, it grows tax free. And if you pay expenses with qualified education expenses from your 529, you're not going to pay taxes on the withdrawals. The only downside is if you don't use it for education expenses, like let's say your kid doesn't go to college or whatever, and you want to take that money out, you're going to get hit with a tax bill and probably a fine too, or not a fine, but like a penalty. So I do like 529s, but you don't want to put excess amount of money in there just because on the off chance your kid doesn't go to college, that money's kind of locked away. I guess you could hold it there for your grandchild or whatever, but that's 20, 30, 40 years in the future. So that's up to you. So I'd say put a little bit in a 529, look at your state, see what your state offers in tax benefits. And if it's better than, whatever other state is out there, then you stick with your state. If not, then you pick a state. But basically, just Google it really quick. I forgot to look it up. I apologize. But there's like one or two states that have better plans in general. All right. What else? I think that's it. If I didn't answer any of the questions you wanted, just shoot me another email and I'll hit you up with another answer in a live video. But just basically max your tax advantage accounts. If you have to invest in a taxable account, put it in an index fund that tracks total world stock market index. You'll pay a little bit of taxes, but because they have low turnover and low expense ratios, you'll end up better in the long run. All right. Well, I hope I answered your question. This is my lunch break. Let's see what I do for you. I'm starving and I made this video for you. So like the video, subscribe, comment, share it to all your friends so I can get big. You guys have a wonderful day.